Hey everyone, welcome back to Corporate Decoder. Today we're cracking open Generation Income Property's latest annual report. It's like trying to guess what's inside a net lease property. Except instead of a Dollar General, we're hoping for financial gold. Not going to lie, this report makes reading War and Peace feel like a Twitter post. But fear not, we'll get through it together. This report gives us a glimpse into how this real estate investment trust is doing. Are they making money, buying smart, and handling risks effectively? Let's dive in and find out. First off, Generation Income Properties, or GIP, is a company that focuses on buying and managing single-tenant commercial properties. Places like retail stores, offices, and industrial spaces that are leased to just one business. They aim for tenants with solid credit ratings, believing these properties offer stable income and long-term value. For the report card, it's their financial year ended in 2024, meaning this is a look back at the entire year's performance. That's important because there's also transition reports that only cover a specific period, so make sure to pay attention. Let's talk about how much the company is worth. As of June 2024, the market value of the stock held by outside folks was only $9.4 million. It might not sound like a lot, and the public float is definitely low. Now, the number of shares outstanding, the ones that people can buy and sell, was about 5.4 million in March 2025. It's how much of the company is sliced and divided. Like any business, Generation Income Properties faces risks, and they lay it all out for us in their report. Some of the big ones: operating losses, a small number of properties, and relying on single tenants for income. In short, if one tenant has trouble, it can really hurt GIP's bottom line. One thing that caught my eye is the mention of currently own only 27 leased properties. Owning only this small amount of properties makes it difficult to diversify the portfolio. Reading down the summary, you can see that the company depends on a single tenant to make any money at all. And of course, they might also have reasons downturn in the business, for example. The main aim is to continue buying and managing net leased properties. In this kind of lease, the tenant usually pays for most or all of the property expenses like taxes and maintenance. This is where it gets interesting. They like properties that benefit tenants, and they look for strategic locations with shorter lease terms. It's a higher risk, higher reward play. Now, to the portfolio, they state to have about 60% of their annualized rent coming from reliable investment grade tenants. It also states that they're 99% occupied, so it's almost all in use, which is pretty good. Now let's get to the most valuable and interesting part. Here's a peek at where their money's coming from and how it's spread out. You can see the property type, for example, retail, with their location. The important part is the last line. They collect $8.6 million in annual base rent. And to find out a few important tenants, a few of their tenants are 7-Eleven, Starbucks, Best Buy, and Dollar General. These are solid companies, so that's pretty good. Let's see how the portfolio is set up geographically. Florida is fairly high up there with a total of 6 properties, while states like Illinois and Ohio have 2 and 3 respectively. Seems like they may want to diversify a little there. One last thing to note, they will use documents from a proxy statement for their shareholder meeting. Keep your eye on that if you want to know more about who's in charge. Alright, time to check out some core numbers. Revenue from the year of 2024 was around $9.8 million compared to $7.6 million for the year before, so they definitely made more, but let's see what the expenses look like. Checking the numbers quickly shows their operating expenses, general and administrative, building and interest expenses all rose. Overall, there are lots of different increases there to consider in various segments. Their net loss for 2024 was about $4.9 million. They lost money even after making more revenue. Last year, that number was $4.4 million. The most important thing to know here is that their general and administrative expense stayed up there, as well as interest expenses. It's a key component to look at going forward. Now, one very important part is if the company loses its status as a REIT. If the company is established as a REIT, if the short, they must distribute 90% of their taxable income each year to keep that status, or else you are required to pay corporate income tax as well as other complications. Something to think about as an investor is that you don't get a say in what properties GIP buys. This means you're trusting their management team completely and might not always agree with their choices. Here is the market. They said that since the company has 110 million shares of stock, management could release additional shares. In doing so, it would cause large dilution in the equity position of our current shareholders. Additionally, large share issuances would generally have a negative impact on the value of our shares. One risk the company is exposed to comes from entering derivative contracts. Those things can increase the riskiness due to external market conditions. So what's our take after decoding this report? Generation Income Properties has definitely improved its revenue picture, but they're still facing challenges with profitability and heavy expenses. They need to make sure they pick the right properties and keep their finances in check in order to grow. The limited diversity, especially geographically, presents a key threat. They need to prove they can sell the assets at a good price and keep things balanced so they can start paying the dividends. Overall, GIP is a high-risk, high-reward play. If they can navigate these challenges, it could be a solid investment, and if the real estate market takes a downturn, things could get rough and dot. If you enjoyed this video, please subscribe, like, and leave a comment down below to make sure I'll crack even more of these reports.